Welcome to TalkTickers. Today we're doing a deep dive into the Insteel Industries second quarter 2025 earnings call.
That's right. We're going to break down the numbers, management's commentary, and what it all might mean for investors.
Exactly. Our goal here is to cut through the noise and give you the key insights. Let's jump straight into the results. How do they look overall?
Pretty strong, actually. Insteel reported net earnings of $10.2 million for the quarter.
Okay, and how does that compare?
That's a nice jump from $6.9 million this time last year, so significant growth there.
And on a per-share basis?
Also quite good. Earnings per share hit 52 cents per diluted share. That compares to 35 cents last year.
Wow. Okay.
And actually, if you strip out some non-recurring restructuring charges, the EPS was even a bit higher at 55 cents.
So solid profit growth across the board then. What about the top line, shipments?
Shipments showed really robust growth. They were up 28.9% compared to last year.
28.9%. That's huge.
It is. And also up nearly 18% just from the first quarter of this year.
What was behind that surge?
Well, the company pointed to increased activity in most of their construction end markets. Plus, they got a boost from some recent acquisitions they made.
Got it. So demand seems to be picking up quite a bit.
Yeah, it looks like it. This is actually the second quarter in a row they've seen favorable volume comparisons after, a weaker prior year. And the growth was apparently consistent through April, May, and June, even with some weather issues.
Okay, strong demand, strong shipments. What about pricing? Were they able to charge more?
It's a bit of a mixed picture there. Average selling prices were actually down slightly, 2.2% compared to last year.
Oh, okay. Why is that?
Well, hard to say exactly from this, but sequentially from the first quarter, prices were up a healthy 5.1%.
So they are pushing prices up now.
Exactly. And that seems to be a direct response to rising raw material costs. They specifically mentioned steel wire rod, which is their primary raw material.
Right. Steel prices have been pretty volatile.
Very much so. And they noted that the supply of wire rod in the U.S. is getting increasingly tight, which is pushing those prices up significantly. Securing enough supply is a key focus for them now.
Makes sense. You can't ship if you don't have the raw materials.
Yeah.
So how did all this, the higher volume, the shifting prices, the cost pressures, how did it impact their gross profit?
It actually played out quite positively for them this quarter. Gross profit saw a really big jump.
How big?
It went to $24.5 million, up from $15.7 million last year.
Wow.
Yeah, and that pushed their gross margin up too, from 12.3% last year to 15.3% this quarter.
15.3%. What drove that improvement? Was it just the volume?
Volume was a big part of it, definitely. Higher production levels meant their per-ton conversion costs came down.
Efficiency gains, okay.
Right. But also those sequential price increases helped create better spreads over their costs. And one other factor, they mentioned they'd worked through some of the higher cost inventory they acquired back in Q1.
So that inventory normalization helped margins too.
Exactly. And they sound pretty optimistic about Q3 margins as well. They expect continued improvement from strengthening demand, the full effect of recent price hikes, and their current raw material inventory values.
Okay, so gross margin picture looks pretty good. What about operating expenses, SG&A? Did those go up too?
They did. SG&A increased to $10.8 million, which was 6.7% of sales. Last year was $7.9 million, or 6.2% of sales.
What caused the increase there?
The main thing was higher compensation costs, about $1.4 million more. This was linked to an incentive plan based on return on capital. Because they're performing better this year, those costs kicked in.
Okay, so partly a reflection of their own success.
Right. They didn't have that expense last year in Q2. There were also some other factors, like an unfavorable swing on the value of some life insurance policies and more amortization expense from those recent acquisitions.
Got it. And they mentioned restructuring charges.
Yeah, about $662,000 related to consolidating some welded wire manufacturing after those Q1 acquisitions. So some one-off costs associated with integrating the new businesses.
Okay. Let's pivot to cash flow and the balance sheet. How did that look?
Cash flow from operations actually used cash this quarter, $3.3 million.
Oh, okay. That's a change from last year.
Yeah, last year they generated about $1.4 million in the same quarter. The main reason for the use of cash this time was a big jump in accounts receivable.
Makes sense with higher sales and higher selling prices, right?
Yeah.
More money owed by customers.
Exactly. That was partly offset by increases in what they owe suppliers, accounts payable, and also a drop in inventory levels.
How are inventory levels looking?
They brought them down. They ended the quarter with about 2.2 months of shipments worth of inventory, down from 2.8 months in Q1.
And that's good for working capital.
Right. And importantly, they noted that inventory is valued favorably compared to current replacement costs, which, like we said, should help future margins.
What about capital spending? CapEx?
Relatively modest this quarter, $2.2 million. And interestingly, they actually reduced their full-year CapEx target.
Oh, why is that?
They said it was due to resources being allocated to the acquisitions and the integration work. So the new target for the year is $17 million, down from $22 million.
Okay. And did they do anything else with their cash? Buybacks?
Yep. They continued their share repurchase program, bought back about $1.1 million worth of stock.
So overall balance sheet health?
Seems pretty strong. They ended the quarter with $28.4 million in cash and, importantly, no outstanding borrowings on their credit facility. Good liquidity position.
Okay, let's zoom out a bit. What's the company's view on the market outlook for the rest of the year? And how are things like tariffs factoring in?
They expressed cautious optimism. Demand seems to be holding up. Their order book is strong, and April shipments were apparently ahead of last year.
Cautious. What are the concerns?
Well, the usual suspects, really. Uncertainties around U.S. trade policies, potential economic headwinds. It's interesting because some broader indicators, like the Architectural Billing Index, suggest a tougher outlook for construction.
Right. Those haven't looked great.
No. But Insteel says their recent business pace kind of contradicts those broader trends. So a bit of disconnect there, maybe.
What about the steel tariffs? Section 232.
Yeah, the CEO specifically mentioned relief that the 25% tariff is now being applied to imports of PC strand. Apparently, that product line was kind of getting around the tariff before, creating an unfair advantage for imports.
So that levels the playing field a bit for them.
It should help, yes. But they also pointed out that world market steel prices are still way lower than U.S. prices.
So import competition is still a factor, even with tariffs.
Definitely. An advantage for offshore competitors persists. They also mentioned the reimposition of Section 232 on Canada and Mexico isn't expected to be a major issue for their supply.
Any other tariff concerns?
Some uncertainty about potential reciprocal tariffs, maybe hitting capital equipment or operating supplies they import. If that happens and costs go up, they plan to pass it through in pricing.
Okay. And back to that domestic wire rod supply issue.
Still a concern. They mentioned one U.S. mill that was idled is planning to restart, but it's not a current supplier for them. The situation is tight enough that they said they've reluctantly made commitments to import substantial quantities of wire rod themselves.
Wow, so they're having to secure supply from overseas because the domestic market is too tight or expensive.
Seems that way. It's a move to mitigate potential shortages here.
And the acquisitions from Q1, how's the integration going?
They said it's complete and successful. They seem pleased with how those acquired operations are performing and the synergies they're getting.
Okay, so summing this all up, what does it mean for investors looking at Insteel?
Well, you've got strong Q2 results and a positive near-term outlook, which is, pretty encouraging, especially if you're worried about broader macro headwinds.
Right, that divergence you mentioned.
Exactly. Their ability to push through price increases to cover rising costs is clearly crucial and something to keep watching very closely.
Tariff changes.
The PC strand tariff fix looks like a clear positive, removing a headwind. But that underlying steel price gap between the U.S. and the world market, that's an ongoing competitive pressure.
What about the lower CapEx guidance and the buybacks?
The lower CapEx might mean they're shifting focus, maybe prioritizing debt paydown or returns after the acquisitions, or maybe integration just took up resources. The buybacks suggest management thinks the stock is potentially undervalued.
And that disconnect between their performance and some macro indicators.
That's definitely something to dig into further. Is it just lag? Are there specific end markets holding up better? Or maybe inventory cycles playing a role? It warrants a closer look.
Okay, now for our favorite part. Let's talk trade ideas. Remember, everyone, this is absolutely not financial advice. Just some outrageous but plausible scenarios to think about. You have one.
Okay, here's one thought. Given Insteel seems to be doing well despite macro worries and this critical tightness in domestic wire rod supply forcing them to import, maybe consider a long position in Insteel paired with a short position in a broad construction ETF.
Interesting. What's the rationale there?
The idea is Insteel might outperform the broader sector because of its specific market position, maybe benefiting from infrastructure spending or specific niches, plus the tariff help on PC strand. Meanwhile, the broader construction sector ETF could suffer if those macro indicators are right.
So betting on Instill's relative strength against the sector.
Kinda, yeah. Hedging the macro bet a little while playing Instill's specific story. Again, highly speculative, depends on many factors aligning.
Definitely outrageous but plausible. Okay, I'll throw one out too, building on that import theme.
Go for it.
With the uncertainty around domestic wire rod and Instill potentially having to import significant amounts, what about a speculative long position in a shipping company, specifically one focused on dry bulk cargo?
Betting on increased steel import volumes.
Exactly. If Instill and maybe others really have to ramp up wire rod imports, that could boost demand for those specific shipping services. It's super dependent on timing and the actual scale of imports, though.
Very much a derivative play, and timing would be everything. Pure speculation.
Absolutely. Purely food for thought. Okay, well, that wraps up our deep dive into the Insteel Industries Q2 2025 earnings call.
We've hit the key numbers, management's take on the market, tariffs, and the investor context.
And even explored a couple of unconventional angles. We hope this analysis gave you some valuable insights. What are your thoughts? Do you buy the disconnect between Instill and the macro data? Is the tariff situation a lasting tailwind?
We always encourage you to do your own homework, your own due diligence.
Definitely. Thanks for tuning in to TalkTickers.